Okay, greetings, ladies and gentlemen. My name is Nyoman Sherina Devi from Universitas Mahasaraswati Denpasar. Today, I'm very honored to present our research titled Financial Performance in Indonesian Banks, the Role of Ownership Structure, Dividend Policy, and Credit Risk. Okay, so for the background of the study, in the banking sector, return on equity or ROE is one of the crucial measure of performance. So our study here is based on the idea that managerial ownership can align managers' interests with those of shareholders. Also, dividend policy often signals financial health, while credit risk, particularly measured by non-performing loans, will significantly impact profitability. So, what is the importance of ROE and factors affecting it? So, ROE indicates how effectively banks are utilizing shareholders' equity to generate profits. Given this, we examine how managerial ownership, dividend payout ratio, and credit risk will influence the financial performance of banks in Indonesia. So our research problem is addressed in this study is how managerial ownership, dividend payout ratio, and credit risk affect the return on equity of Indonesian banks during the post-pandemic period. We specifically focus on the recovery years from 2021 to 2023. And our study aims to systematically investigate whether these three factors, managerial ownership, dividend payout ratio, and also credit risk, will individually and greatly affect the financial performance of Indonesian banks as measured by return on equity. Next, the methodology of this research. The design using quantitative, using explanatory causal approach, and multiple linear regression to assess both partial and simultaneous effects. And for the respondent, it's 47 banks listed on the Indonesia Stock Exchange observed from 2021 to 2023 using a census method yielding 141 total firm year observation. And for the research instrument, we use secondary data. This secondary data is obtained from audited annual financial reports and official IDA documentation. The variables that measure is the first is managerial ownership. It's the percentage of share that held by management. And the second will be dividend payout ratio. It is the net income portion distributed as dividend. And the third is credit risk that we use non-performing loan ratio here. And the last one is the dependent variable. It's return on equity as the last variable here as the dependent variable. And for the data collection, financial data were compiled from published annual reports and IDA's website. And for the data analysis, we use descriptive statistics and multiple linear regression analysis at 5% significant level to test our hypothesis. And for the results here, the first is for the profile of the samples here, sorry. So the samples is we involve 47 Indonesian banks that listed on the IDX from 2021 to 2023, and the census method deals with from 141 from your observation. We use secondary data source and examines these variables that these are manager ownership, dividend payout ratio, credit risk, and return on equity. For the results here, for the first hypothesis, it's how is the effect of managerial ownership on ROE? The results show that managerial ownership has a positive and significant effect on return on equity. So this supports the view that when managers have equity stakes in the bank, their interests will be aligned with those of shareholders, promoting better financial performance. And we found this is consistent with the finding by Alcordi et al. In 2021, who conclude that ownership structure positively impact from performance in emerging markets, including listed financial institutions. And similarly, with other study as well, emphasize that internal ownership incentive play a role in influencing risk taking and profitability, particularly within financial intermediaries. And what with the second hypothesis here is effect of dividend payout ratio on ROE. So our analysis reveals that the dividend payout ratio doesn't significantly affect ROE in Indonesia. This may imply that dividend decisions are driven more by liquidity management and regulatory requirement than by profitability. So this is aligned with other study that like Nianti et al. In 2023 that found that while dividend policy plays a role in signaling, its direct effect on financial performance may be overshadowed by other structural or macroeconomic variables, especially in post-pandemic financial environment. As dividend payout may not be a strong indicator of performance under such conditions. And for the third hypothesis, the effect of credit risk on ROE, the findings show that the credit risk proxy by non-performing loan ratio, NPL ratio, has a negative and significant effect on ROE. So this concludes that an increase in NPL directly reduces profitability due to higher provisioning and declining asset quality. This is in line with Ekisi and Poiras in 2019, who reported that credit risk negatively impacts financial performance in Turkey deposit banks. And moreover, the other study also confirmed that the rising credit risk weakens bank profitability across Islamic and commercial banking sector. And similarly, the study in 2025 also highlight the role of ownership and control mechanism in moderating credit risk and its influence of financial. So we come to the conclusion. So this study concludes that the managerial ownership and credit risk significantly affect bank financial performance, while the dividend payout ratio does not. And the high managerial ownership foster accountability and efficiency, where high credit risk will impair profitability. Dividend policy in this context may not be a reliable performance indicator. So this insignificance of DPR suggests that dividend may be driven more by institutional constraint than performance. Okay, so naturally, our research is, of course, we have some limitation. Our limitation here of the findings that the first is the one that we use is return on equity as a measure of performance and only that one. So that's our limitation. And also we did not include control variables like bank size or maybe leverage. And we only focus on the past pandemic period, which may have unique influence. And what is the practical value of the findings? So our findings here may have direct implication for banking stakeholders, such as banks should promote higher managerial ownership to align incentives and improve performance. by strengthening risk management system to enhance the screening, early warning mechanism, and improve recovery strategies. We can help reduce NPL and bolster profitability. And the last is investor can use managerial ownership and credit risk as a key indicator for evaluating bank performance, while regulators should continue refining oversight frameworks in governance and also credit. And our suggestion for future research, future studies or future research should explore other financial indicators as maybe return on asset or net interest margin. And it will be great if you can include control variables like bank size or leverage that this will be improved model robustness. And longitudinal or qualitative approach may also help to capture deeper dynamics in managerial behavior and risk policy implementation. So this is for the reference website, and that concludes my presentation. Thank you very much for your attention, and see you.